that is a good shot of that happening, and unfortunately, history repeating itself if we enter into these two definite changes. With the removal of minimum, guidelines for credit scores, I think in itself is a very risky move. But in combining that with 50-year mortgages, now you have someone that's not even qualified to get a mortgage credit wise, and you're giving them that mortgage for another 20 years. They're locked into it. Right? We already know that these people have bad credit, and there's a great likelihood that they're not going to make their mortgage payments. So we're going to see an influx of short sales and definite foreclosures if that's the case. Imagine cutting your monthly mortgage payment from by nearly half, but really increasing your payments by decades. That's the reality of the 50-year mortgage proposal that Trump just came up with. And we're going to talk a little bit today about the positives and the negatives of the 50-year mortgage if it actually comes into play. Good morning, Peter. How are you doing today?
Good morning, Sharif. I'm good. How are you?
Doing well, man. So I want to talk about this topic both for consumers and for agents because this could be like a game changer for the industry. A 50-year mortgage has been outlawed so far, and hasn't been allowed. And Trump is trying to propose that. What is your feelings about that, Pete?
It's definitely interesting to see what's going to happen. Obviously, it's not 100% approved yet, but if it does get approved, what's going to happen is that obviously the monthly payments are going to be lower, which allows buyers to catch up with the inflation of home prices, which obviously are increasing by the months, really, at this point. But obviously, there are concerns. Everything has consequences, and I think the consequences they might not realize now, but they will see down the road, which is definitely could be good and bad at the same time. I don't know if there are going to be any sorts of penalties. I don't know if they're going to have any type of clauses in there where they're able to pay it off quickly or not pay it off quickly, and what does that look like? So, and I don't know if that means that we're not going to see any lower interest rates than 6% for a very long time, and that's why maybe he's proposing that. What do you think, Sharif?
It's really it's up in the air right now, right?
Yeah,
But just the basics of it, 50-year terms equal lower payments, which is great. But we're going to extend amortization of that loan. So you're going to pay more over the course of the loan. Now, target audience for this is probably first time home buyers. Those are typically priced out of 30-year mortgages or even 15-year mortgages. The fact is, the current rules limit that. This will require changes in legislation and regulatory actions. So it might not even happen anytime soon with the actual changes that need to be made, but it's a proposal. And what we see is it could also bring in the younger generation of buyers, being able to take, more of a step towards purchasing property because their payments will be lower. And I think that's really the issue that people are having right now is that, over the past couple of years, because of the increase in interest rates and with the term that's set for now, mortgage payments have skyrocketed almost more than what rents are right now. So, in order to get these first time home buyers, those younger buyers, the ones that are less qualified to actually jump into the market, this might be a good move. But there are consequences to this, right?
for sure. I was talking to a mortgage lender last week, and he told me this, and don't quote me exactly on the number. However, before, I think it was like 8 to 10 years ago, the average home buyer age was in the low 30s or even high 20s, right? And now, from, in the last, I would say 3 to 4 years, it jumped up to the average would be high 30s. Like we're talking about 38, 39. That's the average first time home buyer at this point, which obviously is telling us that a lot more of the younger generation are not able to afford buying a home altogether, which is sad. And I think that's what the government is realizing at this point. Like, how can we allow a lot more people to afford getting into a home instead of renting or living with somebody else for a very long time?
And for them, the younger generation, that 50-year term might not seem as something that they would want to go into more now because of the fact that they have a longer term. They're younger in their lives, so they're able to extend out their mortgage just to cut out on their monthly payment. So we might see an influx of those younger buyers coming to the market, which is great. But the fact of the matter is, buyers are going to be able to qualify. That's great in itself. It's going to expand the buyer pool. We're going to see an influx of buyers hitting the market after if this happens. But this could cause, because of the fact that we still have low inventory, could cause the actual prices of homes to spike a little bit now too, like it did within the past couple of years. So it could positively impact. They do see negative impacts happening as well. As agents, we'll have more qualified leads, increased transactions, but is that good for the health of the industry, right? We've already experienced a lot of that happening in the past couple of years, but with the market starting to correct, is this going to allow for a correction, right? Or will this keep the market, on an incline for the next couple of years, depending on how quick this happens?
I think it's my opinion. That's John. Again, this is only my opinion. I think it's a short-term solution to a big problem that we have, and I don't think this is going to solve any. It's not going to solve it long term, right? But again, who knows? There's a lot of things that go into housing crashing, not just talking about like interest rates or down payment or qualifications, but also depends on inventory and foreclosures and people not being able to afford their homes. I mean, another thing that I noticed a lot, I was speaking with Amber from Bill Sokol's office, who you referred me to yesterday at the event. And she was telling me the number of foreclosures and short sales that have been hitting her desk have increased by 500% in the last 3 months alone. Right. And that's here, obviously, in New Jersey. New Jersey's always been one of those top states of foreclosures and short sales overall in the nation. But it's like that spike also is telling us that, we know that people are getting laid off, people are not able to afford their homes, but maybe this is just also the government trying to help with that. So this way, maybe gives them an option to maybe refinance into a 50-year mortgage. So this way, they'll be able to afford their home and not lose it altogether.
Yeah, definitely. I mean, we're seeing these changes. We're seeing that FHA has also removed the minimum credit scores. Although that's positive for some buyers, we're also going to see a shift in the market because it's almost a repeat of what happened in the mid 2000s, right? 2005, 2006, 2008. Like when the actual market crashed because we had non-qualified buyers purchasing homes, and that resulted in a whole slew of short sales and foreclosed properties after that. I'm not sure if that's going to repeat itself now with the combination of these two changes. So we're talking about the positives of it. It's great. Add more flexibility for buyers. We're going to see more enter the market that can able to afford homes because of monthly payments decreasing. But the negatives, I think, will outweigh the positives, right? When we're looking at it, people are building equity at a good rate right now, even better rate in the past couple of years than we've seen from the years prior to that. But if we're thinking about 50-year mortgages now, that's going to be a slower increase of equity that people are building in homes. So that's going to, cause the fact that, people are going to tend to stay in that property longer now. And we're going to have yet again a shrinkage of inventory. Higher lifetime interest costs and long-term financial burdens can increase even if these monthly payments are lower. So even though the short term is positive, the long term could be a negative impact with the decrease in equity, basically gaining it over time. So it's going to distort the market a little bit. Potential inflation in home prices, like we spoke about. We'll have an artificial demand spike like we did when we had a lower inventory with lower interest rates. Now imagine if we have longer term with lower monthly payments, could be that artificial spike in the market because of the lower inventory, because of the blast of people that are going to hit it. And there's also all these regulatory hurdles that we're going to have to get through, right? Qualified mortgage rules and underwriting standards would need adaptation to a 50-year instead of 30 or 15. But definitely the slower equity accumulation may reduce the people moving or even listing homes frequently. So we're still going to have an actual inventory issue. And then also just the financial status of people because of equity not building up as quick as it used to. So we're definitely going to see some negative acts of this if it actually does happen.
One thing I just came across my mind at this point, as obviously you were saying, equity is not going to build as quickly as it did the last few years. One of the things that we know 100% that's going to happen is that people move because of certain life circumstances, right? So it's very difficult for me to say, like, oh yeah, you're definitely going to live in the same home for the next 50 years. But like, think about job relocations, or people that have to downsize or upsize, or maybe like their family expands, right? Like, we talk about the 5Ds a lot, right? Like diapers, diamonds, divorces, diplomas, and death, right? And those are circumstances that cause people to move. So, for example, God forbid something happens to you, or that you have to sell, and you've owned the home for maybe 3 to 4 years or 5 years, even at this point. When you try to sell that house after paying all the fees, expenses, and everything, you might not anything, or even you might be in the negative, right? And that's what Sharif is talking about with like equity not being built as quickly, because in the last couple of years, especially during COVID, we've seen that people bought their home in 2020, and they had like almost 50% to 100% increase in their prices at some points in some areas, right? But that's not going to happen. Like, for you to sell your home and even to break even, that may require you to stay in the home a lot longer than you had to in prior years.
Yeah, totally, totally. And what does that do for us as professionals? Well, now we're going to have different conversations with our clients, right? We're going to have different conversations with those potential buyers and sellers. And we're going to have to be educating buyers, right? We need to explain the trade offs between lower payments and the actual total cost of your loan. That is something important we need to address with our clients because they're going to see lower payments, right? But we're going to have to let them know, what does that do for you, though? Although great, you can more affordable for a home in the short term, what is that going to do for you in the long term? And then first time home buyers, budget conscious buyers, entry level market, buyers are going to get the most benefit of this. But the fact of the matter is, it's going to shift the market, right? Potential changes in turnover and inventory in certain neighborhoods could be drastic. And honestly, we just got to keep communication up with everyone and try to educate as much as possible.
Right. Another thing too that I know we saw in the news around the same time is the minimum credit score by Fannie Mae got removed altogether. It used to be 620, and now they're saying there will be no minimum. I think starting sometime next week, they're going to remove the minimum credit score. So if your credit score is 500, even, like, you could still qualify for a mortgage, I guess, if you have the income and the down payment, which is also something that is, to me, is a little scary, because I feel like it's almost a repeat of 2007 or 2008, because that's the whole idea. Like, lenders were just giving away mortgage to anybody that can breathe, literally, at this point. Like, and that's what caused the market to crash and spike the home prices. And when we a lot of people went to foreclosures, they were using their homes as an ATM machine and buying dumb stuff with it, like boats, cars, and bikes, or whatever it is, and depreciating assets. That's what they were buying. So, what are your thoughts on that, Sharif?
I mean, I think that is a good shot of that happening, and unfortunately, history repeating itself if we enter into these two definite changes with the removal of minimum, guidelines for credit scores. I think in itself is a very risky move. But in combining that with 50-year mortgages, now you have someone that's not even qualified to get a mortgage credit wise, and you're giving them that mortgage for another 20 years just to lower their payment. They're locked into it, right? We already know that these people have bad credit, and there's a great likelihood that they're not going to make their mortgage payments. So we're going to see an influx of short sales and definite foreclosures if that's the case. And it's unfortunate because we don't want that, right? We just got out of that. It's been 20 years since that. Like, we don't want to go back and have history repeat itself. But us as agents, we really need to stay informed about policy updates and lender programs, right? So that we can educate our clients better. We're going to have to prepare better scripts to include the 50-year mortgage trade-offs to clients. Great, you're getting a 50-year mortgage. Here's the positive, here's the negatives. We're going to have to develop those. We're going to have to highlight local market implications, just as pricing, inventory, and also buyer competition. No one's thinking about that. It's already a very competitive market. We're going to increase the competition just by introducing more buyers to the market. And then basically, we want to make sure that everyone knows about that, right? Just not that you're saving money on the short term, but the implications that it has on.
So, and I wanted to like maybe dive a little bit deeper to because obviously there are going to be people who are like, oh, this is great for people to be able to afford homes and gives people that have bad credit a second chance at owning a home or home ownership overall. But what causes a credit score to drop to begin with, right? And at least from my understanding, is typically because of somebody that has had late payments or missed payments who didn't pay their bills for a very long time, or maybe they have outstanding debt they haven't addressed, right? So when we're talking about that, like we want to also see like, does the debt to income ratio get affected at all, or is just the credit score? So maybe if, let's say, they don't have as much debt, but just their credit score was impacted because of a mistake that they did a while ago, and it just taken a while to repair that credit score, is the debt to income ratio going to shift or change at all? What are your thoughts on that, Sharif?
I think it will. I mean, debt to income ratio is definitely going to shift. In reality, you're gaining more debt by having a longer term mortgage, right? So it could actually narrow your possibilities of purchasing another property or property down the line. Also allowing people with bad credit to purchase. Obviously, like the biggest impacts on credit is exactly what you said, Peter. It's the fact that people have not made payments or made late payments. Their DTI is too high, things of that nature. And we're going to see an influx of buyers that have those cases and purchasing properties, which I think is very risky for the actual market.
And that's another thing too. Like, I think the average American's got like maybe like $5,000 in their savings account, right? So now combining that with FHA, where the minimum requirement is 3.5%, and also your score is no longer required at all, and you have 50-year mortgage, and people are not really estimating things like repairs that may happen in their house. Like, you may get, I mean, you may need to replace a roof all of a sudden, or you may replace a heat or something that happens, right? But it's also something where, like you said, we really have to educate the buyers. Just because it is an option that's available for people out there, it doesn't mean that they should go ahead and jump into it. Obviously we want to help everybody to get into their home. It's a big step in their lives, but also we don't want them to be house poor, right? Like, it's more of a burden for a buyer to go into a home that they think they can afford just maybe 6 months from now, or a year from now, and they just don't know what they will have to come out of pocket for over time, just because of things like maintenance, repairs, and all these things. So it sounds great, but also we always want to make sure that we become the source of education, right? We don't want them to hear a lot of that stuff from other sources, because a lot of times the sources that they hear it from are going to be headlines like the news or whatever, and most people don't read the full article to begin with, and also don't know implications. A lot of times the headlines are just selling fear or something that may happen that doesn't even happen at all, right? Because they're all clickbaits.
It's all about ratings, right? They're just putting it out there just for ratings, but in reality, they're not talking about the implications of it all.
For
When
sure.
this policy passes, we'll need to revisit how we're doing business, right? We need to revisit on how this actually impacts transactions, right? We really have to think about that. We have to think about how it's going to impact interest rates. Is it going to bring them down because we have longer terms? And we'll need to know how this affects the real estate market in real time, although we don't know right now because we don't know if the policy is going to pass. But we'll have to try to figure out like what type of results we'll have out of that if it does pass. So that's something we need to think about and definitely build out ways to educate our consumers so they understand the positives and negatives of it. Because just the way that the media is spinning it, it all looks positive and there's no negative that comes out of it. But we know that there's always a negative with a positive. There's always something that is effect of what you make a change of. So that's something that we need to definitely educate.
And now, when does that part happen? When does the educational process of a real estate agent and a consumer happen typically, Sharif? Like, for those that are not doing, what I know you were probably going to say next, like, when should they do it, and how should they do it to begin with?
I mean, the buyers and buyer consultation. right? When you're first, interacting with a person, you should be consulting them about the buying process, especially first time home buyers, the younger buyers, things of that nature. We definitely want to do that during a consultation phase. Explain to, because during our consultation, we do break down types of mortgages and terms of mortgages. So we need to explain to them, comparison to the 30 and 15-year options or 20-year options that you might have. These are the differences between, and this is what you'll result between each one of these type of mortgages. So I would think during a buyer consultation, obviously with a buyer, you also want to probably introduce this in a listing consultation when you're talking to your sellers, especially when you're talking about market activity and things of that nature, the amount of buyers out there. So I would think it's definitely during a consultation phase before you do the legwork, before you're actually working with the person. You want to educate them about, what the market is today and what their options.
Yeah, I agree. I agree. And it's one of those things where a lot of real estate agents don't do. And I think it was just a bad behavior that they've learned during COVID because it was just so easy to sell homes at that point and everybody was making really good money. And they stopped. Everybody stopped doing the consultation. It was like they were more of a door opener at this point. But just like you said, Sharif, like we have to sit down and explain to them which is the best option, walk them through what the buying process will look like before they even start buying a home, even if they've already bought a home before. Like we all know now, things are changing, right? Just because you bought a home 10 years ago doesn't mean that it's the same way as buying a home today in today's market. Things change very rapidly, and every county, like the inventory is different, right? Like we can't say, oh, the market is hot all over New Jersey. No, like there are certain counties and parts of the state that are slower, that are selling less than asking price. And yes, there are certain counties that are selling above asking price. So we can't assume everything is the same just because. And I feel like this is just more a lazy part of the agent because they don't want to really take the time out of their schedule to spend that extra time and really dig deeper and find out what the buyer's looking for and how that's going to really affect them. So I think that extra 30 minutes to 45 minutes that you end up sitting with your client that you meet for the first time will go a long way because now you look like the expert and you know what you're saying, and then you will get more referrals and you build trust, and then now they're going to want to work with you.
Definitely. You want to educate them, right? And let them know, basically that this is a different type of financing, right? This is a longer term financing. Although your payments go down, these are the actual results of that. And we got to make sure that our clients understand that. And they have options too. Maybe they enter into the market, purchase their first property with a 50-year and refinance down to a 30 or a 15. That's an option too. As they, build up in their career, they're making more money. Maybe they want to do that just to cut the term off because we're paying more for a home in reality. I mean, a $300,000 home just at current rates at a 30-year, you end up paying like $600,000 to $700,000 for that home. So we have to explain that to our clients and understand that your equity is not going to grow as much because of that fact. You're paying more interest over a longer. So, definite things that we want to educate our clients on, and just also just anyone you interact with in the market, just so that they understand what's going on.
Awesome. Really good. Really good. Well, this was really helpful, Sharif. And I think a lot of people are going to gain some knowledge out of this. And, I think, again, if you guys are not in tune with the market, you definitely should. Like, you should be the one that is getting the information over to your clients. Don't let them find it out from other sources and come to you. What do you think of this? And you don't know what you're doing or what even that they're talking about. So you definitely need to know what's happening at all times. So now, you can educate your clients in a good way.
Yeah.
Was there anything else that you wanted to add to
Yeah,
the
just because
podcast?
this is so new, Peter, I would just want to add, if you're a buyer or a buyer's agent or you're working with someone currently, how would 50-year mortgages make a difference for you? Right? We want to get some feedback here. So if you could comment below and let us know, how would 50-year mortgage impact you as a buyer or as an agent? What does that do differently for you? Just send us a DM, comment below, just so we get some type of feedback so we can, actually present it in our next episodes or one of our next episodes of the feedback that we receive. That'd be greatly appreciated. But yeah, besides that, we love to bring you guys this type of content. And if you like this content, we definitely would appreciate if you do like and subscribe down below. and maybe share this with a friend. And we will add all the information for not only this podcast, but also our Facebook group that we run, that we also have a lot of educational items that we post on it. It'll be in the comments below. But other than that, thank you guys for joining, and have a great day.
See you guys.